Welcome back to Between the Margins. This is Foundations Lesson 4, How Trades Become Prices. In the previous lesson, we built the basic framework for understanding markets. First, we established that a stock represents ownership in a business and a claim on all future cash flows. Then we looked at expectations and how prices move when reality differs from what investors expected. In the last lesson, we examined how these future expectations turn into a valuation through the process of discounting future cash flows. Even after that, something still feels a little bit unresolved. Valuation alone does not determine the price you see on your screen. Two investors can disagree about a company's value. Even tens of thousands of investors can disagree, and yet the market will still display one price at any given moment. How is that possible? The market price is just the last trade. That's all it really is. The most important mechanical fact about markets is surprisingly simple. The price is the price at the most recent transaction. It is truly just whatever the most recent trade was and nothing more. It's not the average of all opinions of all investors. It's not a vote taken by every single investor in the market. It's simply the price at which one buyer and one seller agreed to exchange shares. If someone's willing to buy a stock at 50 and someone else is willing to sell it at 50, that trade becomes the market price. A moment later, another trade might happen at $50.10 or $49.90. The market price will update again. At any given time, there's buyers willing to pay slightly less than the current price and sellers willing to accept slightly more than the current price. The next trade will occur when those orders meet. Prices don't move because the entire market suddenly changes its mind, but because the next trade happened at a different level. Now, obviously, prices do move quickly in some cases, and that's because individual orders are happening all the time. And when expectations shift, it does happen very quickly, and many orders will move in a certain direction. But the main thing to remember is the marginal buyer sets the price. Most investors are not trading at any given moment. Many long-term investors may hold a stock for years without doing anything at all. If a stock has thousands of long-term holders, but one investor is willing to buy at a slightly higher price, that single transaction can move the market higher. That means that the price is not determined by the beliefs of everyone that owns the stock. It is determined by simply the marginal buyer and the marginal seller, or the next participants willing to transact at a common price. Imagine that thousands of investors believe a stock is worth around $100. And if the next buyer in the market is willing to pay $105 and the seller sells at that price, the market price instantly becomes $105. The beliefs of everyone else did not suddenly change. The marginal trade simply happened at a higher price than the current price. This is why prices can move even when most investors have not changed their views or changed their positioning at all. So now for visualizing this marginal trade. This idea becomes a little bit more clear when we think of any given market as simply a supply and demand curve. In the show notes, I will have this chart posted that you can look at, but I will also describe it for audio listeners. So buyers represent demand for shares and sellers represent supply. The market price is determined where each of these curves meet, which is the point at which the next buyer and next seller agree to transact. So the easy way to visualize this is a simple supply and demand curve. We have quantity on the x-axis and price on the y-axis. As the price goes up, our supply curve goes up. There's more quantity of shares available the higher the price is. And conversely, the demand curve goes down. As the price gets lower, the quantity of shares people are willing to buy goes up. So we have essentially a big X as the chart, with supply going up and demand going down. And that midpoint is the equilibrium price, with a specific amount of shares willing to be traded at a specific price. So That intersection is essentially, like I was saying, the next marginal trade. When the demand or the supply shifts, that intersection point moves, and the price will adjust based on that. So, for example, if there's really good news for a stock, the demand curve might move up, which will cause the demand line to shift to the right, causing the intersection slash equilibrium point to move up in price. Conversely, if the supply goes up, we'll see that supply curve shift to the right, which will cause that equilibrium, that intersection, to move down in price. Importantly, this process can occur even if nothing about the underlying business changed, because every single individual trade placed is another data point on this supply and demand curve. So liquidity and market depth are kind of the next pieces to this puzzle. Liquidity refers to essentially how easily a stock can be bought or sold without moving the price too much. In a highly liquid market, there are very large amounts of buyers and sellers at prices at or close to the current market price. Small trades won't move the price at all, and large trades don't impact the market too substantially. In a thin or illiquid slash low liquidity market or stock, that situation is a little bit different. If there are only a few buyers available at or near the current price, a seller may need to accept a much lower bid to complete their trade, leading to the market price moving. Think of it like there's somebody willing to sell shares at $100, somebody else willing to sell at $95, and somebody else willing to sell at $90. If the person willing to sell at 100 is only willing to sell 5 shares, you have a situation in which you're only able to transact 5 shares before you have to move on to the next price. So the trade becomes the most recent trade is the market price. So when there's a small amount of shares available, you might have to move through multiple orders before you get to the final transaction price. This is why small cap stocks often move more sharply than large cap stocks, and why all stocks often move much more during after hours trading, because there's fewer participants in the market, so even modest to small trades can move prices around. It's not necessarily because the businesses become more volatile, it's just because the market around those stocks is thinner and there's less liquidity to balance out big trades. Another way to think about markets is that they're simply collections of opinions. Or they're not simply collections of opinions, they're collections of balance sheets. Things that constrain investors typically include available capital, leverage, risk limits, and portfolio allocations. When those constraints change, trading behavior will change. For example, a fund that needs to reduce risk might sell shares regardless of whether it believes a company is fundamentally attractive or not, and another investor might be forced to buy because they track an index or they must rebalance a portfolio. Those flows affect who the marginal buyer and seller are at any given moment. So next we should probably get into why prices move even if the valuation doesn't change. This is one reason the markets sometimes move sharply even with nothing happening. The valuation of a business could not change, and the expectations may be largely the same, but a marginal buyer can shift. Liquidity conditions can change, positioning can change, capital flows in and out of the market. And when any of that happens, like I've said already, the next trade occurring at any price is the new market price. So any individual stockholder who's not actively trading does not have any actual impact on the stock on a given day. You could own 50% of a company, and if you are not buying or selling on any given day, you don't tangibly affect the price of that stock. So now connecting it back to the general framework introduced earlier, we have the real business, which produces cash flows, which leads to expectations, which calculates a valuation of the company. And then now we're inserting, before we get to prices, trades. Trades are made based on value, which is what actually creates the price. Earlier, we were being a little bit facetious with valuation leading to price, but the mechanic in between those is the trades. So those first four steps, the business, cash flows, expectations, value, determine what people think a company is worth. But then the final two steps of the trade and then bringing it into the price is what you actually see in the market. Understanding those last steps helps explain why the markets will sometimes feel disconnected from valuation in the short run. And prices are set by trades, and traders are influenced by liquidity, positioning, capital flows, and many other factors. Over long periods, valuation does tend to dominate the equation, but in the short term, market mechanics often take the lead. Thank you for listening, and I'll see you in the next one.